I'd acknowledge the Gadigal people of the Euro Nation, the traditional custodians of this land, and pay my respects to the elders, both past and present. I'd like to introduce our guest speaker. So this is Carmen Ridley. Her full name, Carmen's Principal Director of the Australian Financial Reporting Solutions, is a member of GAP Consulting's network and a former member of the Australian Accounting Standards Board. So Carmen, which you all know, has an excellent knowledge of financial reporting, and it's through significant experience both in external audit and technical divisions and spends significant time analysing and interpreting accounting standards for clients. So Carmen, it's over to you.
Thank you, Aidan. All right, so welcome, as I said, to the people in the room. Fantastic to actually be talking to people and to those online. And I guess when we looked at planning this session, the good news is there is no major new accounting standards. I'm not here to announce a brand new leasing standard or a brand new revenue standard, but we've still got a fair amount to talk about. There's still a lot going on in the financial reporting of the external reporting space. So the intention of this session is really to give you an awareness of what I'm seeing and what is being discussed. I'm not going to turn you into an expert on any of the topics, but there are certain topics that hopefully you will say we need to go away and do a little bit more research on how this impacts us. So let's get started. We will start with the standards update to see what has actually been happening in this space. There are two new standards that I'm going to talk about. There are actually more than two standards that are effective at 30 June, but the rest of the standards just move the effective dates of other standards. So consequently, I'm not talking about those. The first one is only for not-for-profit entities. So if you have attended any of the ENFP sessions, you would be aware I've talked previously about a short-term narrow scope project the ISB worked on. And that was to look at, was there any issues with the revenue standard and could they be changed immediately? One of the outcomes from that project was an amendment to ISB 15, and that was to add an illustrative example to deal with accounting for upfront fees. There was previously a staff FAQ on this, and that staff FAQ still exists, but it dealt with only private schools. And lots of people said, we're not a private school, it's not relevant to us. This example that's been put in the standard is very neutral, and consequently talks about the principles and how to deal with upfront fees. So it might be things like your joining fees, it might be any setup fees, your golf clubs, etc., that you might have with those. The other thing in this standard is for the not-for-profits who have concessionary or peppercorn leases, you would be familiar with the fact that there was a temporary exemption that allowed you to recognise your right of use asset at cost rather than at fair value. And people kept saying to me, every time I spoke to a not-for-profit, they'd say, when's that changing? It's going to be an absolute nightmare when it changes. Do we need to start fair valuing things? This standard actually says that exemption is permanent as a board can get it. A new board could come in and always revise that decision. But any of you who are in that space of not-for-profits with peppercorn or concessionary leases do not need to worry about fair valuing at any time. The next one is an international standard. So as you can imagine, lots and lots of jurisdictions use the international standards, and there is always queries that go back. Can you clarify this? Is this what you mean? Did you miss something here in this particular standard? And what the international board do is they accumulate all those little changes into what used to be called, or still is called, the annual improvements project, because they used to come out annually. They don't now. They come out probably once every 2 to 3 years. But this is the annual improvements project from 2018 to 2020. They're not major changes, they're fairly minor changes, and there's only actually two of them I'm going to talk about. The first one is ISB 116, and that's to do with where you've got a piece of generally plant and equipment that you've installed, and it's to do something. Let's say it's to make the clicker. And it's producing samples, they're just not quite right. They're just not exactly how I want it, but whatever's coming out, I am still able to sell it. It is still a product that people would buy. So what used to happen is you used to be able to offset any proceeds from these sample clickers against the value of the plant and equipment. This clarification says you can't do that anymore. What you need to do is any sales proceeds you get from samples before things are ready for their intended use has to be recognised through the P&L as any other sale. Now, when this came out, I thought it's probably not going to impact a huge number of people. And I got about 3 queries in the first week of this being released. So it obviously does have impact for certain entities, possibly in some of the mining industries as well. But any installation where you are selling things before they're ready, just something to be aware of that has changed. I reviewed an accounting policy of quite a major corporate a few weeks ago, and it was very clear in their policy that any samples that they had were able to be offset against the value of the property, plant and equipment. So just make sure that if it's in your policies, needs to be updated, because any non-accounting people may continue to think they can do that. The other one I want to talk about is the AASB 137, and this links into what I'm going to talk about the economic environment a little bit later on. We are not in a great economic environment at the moment. There is not a lot of positive news happening. What this amendment does is gives us some guidance around looking at whether costs that we are incurring should be included in assessing whether a contract is onerous or not. So an onerous contract means that we're undertaking the contract, we're actually effectively making a loss, but it's easier or cheaper for us to continue with that contract and make the loss rather than try and buy our way out of that contract. So AASB 137 requires us to look at all of the contracts in place, work out whether they are loss-making, and gives us some guidance around which costs we should look at. If you are in a situation that you are in any fixed price contracts, you may well find that they have become onerous because prices are obviously going up. You don't have the ability to increase those prices. You ended up in not a great situation. And we're seeing this particularly in the construction industry. I know I'm from Melbourne, and in Melbourne, we've got construction companies who are offering to pay people $25,000 to rip up their contract because the losses that they are making on those contracts, if they go ahead with them, will be way bigger than that. So just be aware, have you locked yourself into anything, and has it turned onerous? If it has, we recognise a loss immediately. So we always try and spread a profit, but a loss we have to recognise straight away. That's why it's so important. So that's the standards that are effective for 30 June 23. And now I want to talk about a standard that is not effective until December 2023 and for June 24. And it's a standard that I wanted to ignore. I was really quite happy sticking my head in the sand about the standard. I didn't want anything to do with it because I don't deal with insurance. I don't really have any insurance company clients. So that was my attitude, and it's probably the attitude for many people listening. We're not an insurance entity, we don't do insurance contracts, can just rest for the next little bit of time while she talks about this standard. However, given what I do, I thought I probably should do some work on this, and lots of things kept coming out about AASB 17 or IFRS 17 for non-insurance companies. So the more I started drilling into this standard, unfortunately, the more I realised that it actually has more impact than we think on a lot of us. This standard is a standard that deals with insurance contracts. It does not deal with insurance entities. Now, you still might be thinking, I don't issue insurance contracts. However, if we think about the definition that's included in this, and I don't have time to give you a great big details on AASB 17, unfortunately, but the definition of an insurance contract will capture things like warranties that you issue. It might capture things like financial guarantee contracts. It will capture things like fixed fee service contracts. So the easiest one to think about in that context is your roadside assistance. You pay $300 to, I think it's an RMA in Sydney. And if something happens with your car, you can call them out. They'll come out as many times as you want for that one price. Those three things as examples will generally meet the definition of an insurance contract. Now, it doesn't necessarily mean you have to do insurance accounting under AASB 17 because it has some scope exemptions. What it does mean, however, is you need to assess whether you have any of those things, which will flip you into 17, and then you need to consider whether you can get back out of 17 because of any exemptions. And you need to document that particular process. So if I look at things like warranties, why is a warranty captured? Because effectively, if the issuer of that contract is protecting the policyholder, let's say we've got the washing machine, protecting the owner of that washing machine against it breaking, they're going to come out, they're going to fix it, they're going to replace it. They're actually not insuring them against any change in value of that washing machine. They're insuring them against anything that goes wrong with it, which is an insurance risk. And if something goes wrong, the policyholder has an adverse effect. So it meets that definition of an insurance contract, even though traditionally we've never thought of a warranty, never considered putting it in an insurance contract standard. The good news is that under AASB 17, if the warranty is issued by the manufacturer or the retailer, in conjunction with the sale, you are exempt from the standard. So I'm pushing you in, but then I'm hopefully pulling you back out again. And we're aiming to be out of 17 because the accounting in 17 is really hard. But again, it's about that documentation. But even something like that, if we look at some examples, let's say I go to Harvey Norman and I buy a washing machine. And Harvey Norman say to me, would you like to buy an extended warranty? We will do the extended warranty. If something goes wrong, it will be Harvey Norman staff. We come out and fix it. We're the ones that you contact at all times. That's a warranty issued by the retailer at the time of the sale in conjunction with the sale. So I'm exempt. If I buy the washing machine and they say to me, would you like to buy an extended warranty? It's run by Aiden's company. If you've got any problems with it, Aiden's company will come out, they'll fix it, you go to them. Because that warranty is not issued by the manufacturer or the retailer, that means that Aiden has to account for that in accordance with the insurance contract standard. Whereas previously, he probably hasn't. He's probably done it in accordance with the revenue standard. If Harvey Norman say to me, would you like to buy a warranty? And I say, no, I'm okay today, thank you. And they say, anytime in the next 10 months, you can come back and you can buy that extended warranty. Then is that in conjunction with the sale or has too much time passed in relation to that? Still differing views around that, still some different judgment involved in that. So if you issue warranties on anything, please, you need to look at this. If you issue any financial guarantee contracts, so some of you may have deeds of cross guarantee in place for your subsidiaries, which means that there's certain financials that don't need lodging with ASIC. Does that meet the definition of an insurance contract? Probably yes. But again, there's certain exemptions that can pull you back out. If you offer any of those fixed fee service contracts, as I said, roadside assistance is the most obvious one, but it captures anything that could be prepaid, a prepaid funeral plan, anything where there is one fee that is paid and people can access your service throughout. So whilst we all want to stick our head in the sand about this particular standard, hopefully I've shown you that there's actually more things that might get sucked into this than traditionally you might think. So the next one I want to talk about is another standard again that is not yet effective. This one becomes effective 1st of January 24, so that's December 24 or June 25. And ordinarily, we wouldn't talk about standards that are this far in advance, unless there is advantages to you for early adopting. And this, we're seeing that a number of entities are looking to early adopt this particular standard. So to give you a little bit of history, back in 2020, the International Board decided that they were going to change the definition of what makes current liability versus non-current liability. And what they said was they were going to remove the word unconditional. Unconditional is quite a high threshold, and they said nothing's unconditional. If you breach a bank covenant, they're going to call on that. It's not unconditional. So they exposed this and issued the standard back in 2020. Now, nobody had an issue with the removal of that word unconditional because it seemed to make sense. What they did at the time, however, is they introduced a paragraph that they'd never ever put out to exposure draft that talked about any covenants that were tested after the year end, 12 months after the year end. And if you didn't meet them at year end, you're going to be forced to hold that whole liability as current. And we've talked about this in previous years. It was not a popular thing that the International Board did, and there was lots of uproar about it. Went back and forward to the International Interpretations Committee, and in the end they flipped it back to the International Board and they said, is this really what you mean? You never exposed it, it's extraordinarily unpopular. The International Board then went away and thought about it again. So in late 2022, we got an updated version of the 2020 standard. This definition still stands, that's what it is now. But what they changed was in respect of the covenants. So they said you need to look at what the date is that the information relates to in the covenant. So let's say I'm a junior end. Does that covenant relate to information on or before 30th of June 2023? And if it does, we need to consider, did we breach that covenant at year end? If we breached it, it's probably all classed as current. If we didn't breach it, we split it between the current and the non-current, as we ordinarily do. So that hasn't changed. What has changed is if the information is tested after that reporting period. So if I'm a junior end and my covenant testing, let's say it's a current ratio, and it's tested on the 30th of September, and it's based on information as at the 30th of September, I don't take that into account for my current, non-current testing at the year end. Why is this relevant in Australia? because in Australia we have a lot of annual review clauses that are tested at a specific date, and it says that if the entity is having an adverse material impact on their financial results, and sometimes it specifies what that means, sometimes it doesn't, but that's not tested until after the year end, depending on the terms and conditions of that covenant. It may be that those liabilities are now split between current and non-current, whereas previously in the past, we have said that if you have an annual review clause, because you do not have an unconditional right to defer, the whole liability is being shown as current. So we have seen entities early adopted this because it allowed them to break up their liabilities into current, non-current split, rather than having a whole lot as current. So something to have a look at. As I say, it depends on the terms and conditions within your bank agreement, but you may find that there's a change there. What the International Board have also done is said that if you are subject to any covenants that is tested after the year end, you need to give some additional disclosures around that. So you have to describe what that is. You have to describe when it's tested to actually give the user some more information. Those disclosures are something that will need to be looked at very carefully to make sure that you've captured everything, and could be quite substantial if you've got a number of different liabilities, number of different loans, and they all have different covenants, which generally they do, making sure that we've disclosed that. Doesn't kick in yet, but say maybe attractive to early adopt, and we've seen definitely at December a number of entities early adopted this particular standard. Just to give you a little bit of an update on what is happening in the, again, not-for-profit space, just to kind of add on from last time I spoke to you. I spoke about the post-implementation reviews that were happening for certain domestic standards that have been issued in Australia. So post-implementation review is where the AASB look at standards that they've issued and they say, is it working the way that we want it to work? Is it doing what we think it should be doing? These are the standards that they've gone out to post-implementation review on. The ones that are most relevant and the ones that got most comments back. First one, income of not-for-profit entities, in particular the interaction between AASB 15 and AASB 1058. And the second one in relation to control and consolidation. So in the not-for-profit space, do we have control as easily as we do in the for-profit space to assess? So for example, if I've got a school with a building foundation, does the school control the building foundation? If I don't own any shares in a not-for-profit, how can I assess control and how easy is it to do that? The comments are currently being assessed. Nothing has been taken to the board at this point in time. So the outcome from this project will either be nothing happens, everything is working, nothing to see here, move on. It could be that the board decide to put out some educational material to try and explain a little bit more about the processes. It could be that there's some minor clarifications to the standards, or it could be a complete rewrite. So we don't actually know at this point. I haven't seen the comments that have gone through, but hopefully we end up where we need to end up for certain one of these standards. So if you are in this space, just be aware we may see some changes here. My last bit on just another not-for-profit update is I've talked previously about how the AASB were looking to propose a tier 3 set of accounting standards. So we currently have our tier 1, which is falliferous. We have our tier 2, which is simplified disclosure. They're proposing a tier 3, which is for certain not-for-profit entities. And it's a much simpler accounting regime. So tier 1 and tier 2, the numbers are identical between them. Tier 3 would be much simpler. The comment period for that closed on the 31st of March. That was taken to the board in then May meeting, I think. And the board have agreed that staff should proceed to an exposure draft. So fantastic news in that space. There was a huge number of comments back. So thank you to everybody that filled in the survey. I'll put any comments back. That's the good news. The not so great news is the timing of that. So the staff paper that went to the board suggested that the staff would be issuing an exposure draft by end of 2024. So without any of my AASB hats on, I'm really hoping that it's much quicker than that. Whilst a lot of the comments that they got back were very positive, there's still a fair bit of work to do, but hopefully we can see that moving a little bit quicker than 2024. If that's the right time frame, we're unlikely to see a standard before 2026. So good news is it's coming, but not any time soon in relation to that one. That's it on my standards. All right, so let's keep moving. So I wanted to talk to you about what ASIC's focus has been. So ASIC obviously being our corporate regulator. Now, regardless of whether you are governed by ASIC or not, this is a great tool to actually look and say, this is what our corporate regulator is finding. They review financial statements, predominantly of listeds, but generally what we see in the listed space is equally relevant to everybody, regardless of what sector you're in. So don't think I'm not governed by ASIC, this isn't appropriate. Most of them probably are. So if we look at what their focus areas were for December last year, now why do we care about December? Because they haven't actually issued the June ones quite yet. They generally would come out in mid-June. I'm not expecting a huge amount of change. These focus areas are things that ASIC are telling us that they expect to see either the most mistakes occurring, or because of the current environment we're in, it's really areas that directors, that audit committees, that finance members have to be thinking about when they are putting together their financial statements. Number one, which is generally always number one for ASIC, they call it asset values, but what they mean by that is impairment. So it's effectively saying, are you carrying your assets at too high a value? And the ones that particularly they've focused on is they've talked about goodwill, which they always do because goodwill is always the first thing to be impaired. And whenever we see that they're misstatements, we find that goodwill is often not written down as quickly as possibly it should be. They've talked about property assets. Now, property is really interesting at the moment because depending on which day you read the paper, it depends on what's happening with property. It's either about to go up or it's absolutely plummeting and it's in free fall. And it also is varying between commercial and residential properties. So depending on what you've got, depending on which area it's in. Again, in the paper yesterday, I saw a comment that I think it was in the however many capital cities, we still are not back to as many people coming into the CBDs as we were before COVID levels. So what's that actually meaning for any properties that we are renting? Because it could have an impact on our right of use asset. We might have to write that down because there's lots of vacancies. It could also have an impact on any properties that we're actually building, particularly if they're located in CBD. So I would encourage you to at least have a look, whether you hold them at cost, whether you hold them at fair value, try and get an understanding of what the value of those buildings actually are. The next one in the asset values is to do with expected credit losses on loans and receivables. So when we think about impairment, we traditionally think about our non-financial assets, our infrastructure, property, plant and equipment. When ASIC think about asset values, they're also covering that financial assets as well, our bad debt provisions effectively. Why do I think that this will still be very, very relevant for 30 June? Because of the current economic climate that we are in. Interest rates keep going up. So depending on who the counterparties are, you may find people are actually struggling to pay their mortgage or struggling to pay their bank loans. Depends what product you are selling them, that might not be a priority. So we're expecting to see that some of those debtor days really get pushed out. Maybe that they don't turn bad, but the time for you to receive that cash is much longer. If that starts to get above 12 months, you're looking at the time value of money, which will cause an expected credit loss provision to be recorded. So don't say that because you've never had a bad debt provision, you've never put an expected credit loss in, that you won't have one this year. Your auditors are going to be really challenging you about, is that the case? Who are the counterparties? Remember, when we look at expected credit loss, we look at our history with that particular counterparty. We look at the current economic environment, and we also look at the future, what we expect to see. So which industries are you dealing with? Which locations are you dealing with? Because we're seeing very different impacts depending on industries and locations as well. The other assets that ASIC picked on is inventory. And one of the reasons for that is because obviously prices are going up. People are having to spend more to get the inventory in. We are also in many cases having to buy that inventory in much bigger quantities to be able to get ships to come to Australia. So consequently, this inventory is landing, but demand has dropped because of where we are in the economic climate. So are we having to discount? I feel like almost every day in my inbox, I get another email that tells me about another one-off sale that's happening with huge discounts that are occurring because it's the only way people can get the products out the door, particularly if it isn't a non-essential. we don't see sales on milk because we all have to go and buy the milk regardless of what price it's gone up to today. But a pair of shoes, for example, we're seeing some significant discounting. So what industry are you in? And are you having to reduce below cost? Unlisted investments has always been a challenge. Ever since AASB 9 came in that said that we can't hold our unlisted investments at cost, we have to hold it at fair value. The reason that unlisted ones are the challenge is we can't just go to the ASX and pull what the price of that is. It is very much trying to get an understanding. If we have got a 5% interest in an overseas entity that we've never got dividends from, how do we get that fair value? Zero isn't probably appropriate, cost probably isn't appropriate, but how are we actually going to go about getting that fair value and have we documented that? The last one that ASIC raised is around deferred tax assets. And what has been happening with deferred tax assets is kind of pre-COVID, people were recognising deferred tax assets because things were going really well and we may have been in a loss-making situation, but we're going to start making profits so we can recognise our deferred tax assets. And then COVID hit, but we didn't want to take this asset off because that would have meant an expense. So we just kept it sat there. And then we kind of thought everything would get better. And now it hasn't necessarily got better, but we've still got this deferred tax asset sat on our balance sheet. Just because it's been there before does not mean it's appropriate to hold it now. So when we think about impairment, we have to make sure that we've got some evidence for the recoverability of that deferred tax asset in the not too distant future. So it's not that we're going to recover it in 20 years' time. We have to make sure that we've actually got some evidence that we'll be able to utilise it. So that's the impairment bit. If we look from a provisions perspective, and you can see that the focus areas that they've picked reflect where we are in the current economic cycle. None of these are overly positive. Do we have the need for an onerous contract? So I talked, when I talked about that new standard, about how we're locking ourselves into fixed price, or if we have locked ourselves into fixed price contracts, we may well have onerous contracts that are occurring. So ASIC are acknowledging that. Make goods. It is something that since the new leasing standard came in, we've been very much talking about. Are you leasing a piece of property and you have to rip out all of the leasehold improvements you put in? Why this is a bigger issue this year is because you may have been intending to stay in a property for 10 years because you were going to renew the option. Nobody's working in the office now. You've got half the office empty, so you're probably going to give up some of that lease after the first option, which means that a provision that you put in that you thought was out here is not. It's actually back here now. So is the value of that still appropriate? Are we assessing that? Restoration type costs in the mining industry, again, costs are going up. Have we appropriately accounted for that? Financial guarantees is interesting because what we've always done in the past is we've said we've issued a financial guarantee, we've issued a deed of trust guarantee, possibly to avoid lodging financial statements, but possibly to help the subsidiary get a loan, and that's the only way that they could get that. And we've always just disclosed that. What ASIC are highlighting is if the entity that you've issued the guarantee to is not doing very well, has that become a provision? It's no longer a contingent liability. Has it actually crossed the threshold to become a provision, and therefore potentially we have to recognise that in our books as opposed to just having disclosures. So again, making sure that we understand what the terms and conditions of those guarantees that we've issued, and do we understand the financial position of the entity whose debts we have guaranteed. Restructuring. Unfortunately, we are expecting to see a significant number of announcements about restructuring between now and the 30th of June. In order to recognise a restructuring provision, it has to have been announced and to the relevant people, which is often via the media, it's often via the trade unions, and we have to have a formal plan in place. You cannot recognise a restructuring provision until you've met those two criteria. So consequently, it's between now and 30 June that we'll see entities announcing in order to get those provisions through. Have you looked at it? Have you understood it? I have worked with numerous entities in the past who've realised in July that things weren't great and they are going to have to do some major restructurings. They then want to try and push back the provisions to 30th of June, but if you haven't done the work you need to do pre-30th of June, you can't recognise that provision in that case. Solvency and going concern kind of speaks for itself. We are again expecting to see a significant number of going concern disclosures that have to be very specific, not boilerplate. You have to effectively tell me the story. Why is it appropriate for you to continue on a going concern basis in these financial statements? What are you doing to reduce your costs? What are you doing to try and raise money? What are you doing to try and get your debt down? And what's your backup plan? What's plan B in relation to this? We're also expecting to see a number of changes in audit reports in respect of going concern as well. So if you're looking at your results as you're thinking about planning for your audits, making sure that you are talking to your auditors if you are in any doubt about going concern or the numbers prima facie don't look pretty. So if you've got negative net assets, if you've got negative current assets, and if you've got negative operating cash flows, each of those are massive red flags from going concern perspective. Events after the reporting date. I think ASIC threw this one in there and have thrown it in for the last couple of times because for a couple of years, 30 June kicked and then everything seemed to go horribly wrong. I'm in Melbourne and we are both lockdowns were I think in July. You had a major lockdown in 1 year. So I think ASIC had just put this in to go, we don't know what's going to happen between 30 June and the date you sign your accounts. So please make sure that you have a process in place. If I was to ask the auditors I've got in the room and say to them, what do you do about events after the reporting period? They'd be able to tell me that they've got a very specific program that they do when they go out to do the final audit. They then do another check prior to signing the accounts. From a preparer perspective, if I say, what do you do about identifying events after the reporting period? Not so great, not such a formal process. So make sure that you understand what's happening from a macroeconomic level and also within your own organisation. Is there anything that's likely to change these numbers or require much more disclosure in the financial statements? Remember that events after the reporting period start on the day after the end of your reporting period. So if your June year end starts on the 1st of July and goes up to the date that the accounts are signed. So it's that period, it varies for everybody depending on when your accounts are being signed. The last one is disclosures. And I guess the issue around disclosures, I review a significant number of financial statements. And lots of times what I write when I review is this is boilerplate and it doesn't tell me the story. Give me some more detail about this. It's very easy to roll the financial statements from year to year and just add in or change the numbers slightly. We have to take that step back and saying, are we actually telling the story of what's happened in this particular year? Are we being specific to our own organisation? Or have we just copied these from a set of model accounts? Or did we grab somebody else and go, they look like good words, let's put those in. We need to make sure that very, very much what we're telling is our story, not anybody else's story. And it is the story of the current year, not what we've had in there previously. So very much encourage you to look at that to make sure that you do have the appropriate words in there. And it can be time consuming, but you might be able to do a lot of that pre-year end. Just describe things that have happened. You don't necessarily need the numbers. You just need to actually describe the transactions. So I talked about ASIC restatements, and what I've done on this slide is just effectively summarize the ones that we've had this year. So we're only in May this year, yet we've had a number, and I've grouped them into the different areas. So if we start over on number one, shouldn't be surprised based on how much I've just talked about asset values to see that that is the one that has got the most changes. So in respect of impairment, and they have pulled both financial and non-financial assets in relation to that. Now, these funny little numbers in front of them are the ASIC media release numbers. So I would encourage you to have a look at those. Not necessarily telling you to subscribe to the ASIC website because you get lots and lots of these media releases, but these ones are particularly relevant in the financial reporting space. The interesting thing about a couple of these is in respect of impairment indicators. So one of these entities had a very explicit impairment indicator that was listed in the standard, but they still haven't done impairment testing. Our impairment standard includes, I think it's 7 impairment indicators. One of them is market interest rates have increased. Now, I don't think there is any entity that could argue to me that they have not got an impairment indicator at 30 June. Market interest rates have increased. Another indicator is that you have suffered decline in economic conditions, markets, laws. Again, we probably have all suffered that. So you may have in the past been able to say, we've got no impairment indicators, we're not doing impairment testing, move on. I think incredibly challenging, if not impossible, to be able to tell me that that is the case at 30th of June. So if you haven't started considering your impairment testing, please look at this. Those indicators cannot be ignored. And as I say, the fact that market interest rates have been going up however many times in the last 12 months is a very, very strong indicator that everybody is subject to. Provisions and contingent liabilities. Star Entertainment Group. The interesting thing about that one is that it's to do with the Austrac investigation that is happening with the Star Casino Group. And they had not put anything in their financials. They had disclosed a contingent liability. And ASIC came in and said, something's going to happen. You might not know how much it's going to be, but something's going to happen. So therefore, we want a provision. Why do I think that's interesting? Because I get a number of entities who say to me, we don't know how much we're going to have to pay, so we're not putting anything in, we can't reliably estimate it. We've had ASIC tell us that staff have absolutely no idea what that number is, but they want a number in there. So they've got quite a detailed disclosure around that. IDP education is purely contingent liability disclosure. So it's the first time that I can remember in the financial statements that ASIC have put kind of a misstatement through. It didn't affect the numbers at all. It was purely an extra disclosure around contingent liabilities. So again, when we're looking at our contingent liability disclosure, have we appropriately shown everything that should be included within there to the best of our ability? It is the only place in the standard that allows us to use unreasonable prejudice. So we don't need to necessarily include the numbers if disclosing the numbers might give the other side a benefit that probably they shouldn't have. But we need to make sure that we stated that fact. Revenue. I'm surprised there's not more revenue ones. I am getting a huge number of queries on revenue. And interestingly, most of those queries are arising when I get a call from somebody who says, just change jobs. Just come into this role as financial controller, CFO, whatever it is. Look to the revenue recognition policy. I'm not convinced this particular entity is complying with IAS 15. So as we're seeing people moving around, we're actually seeing people look at this a bit more. So again, we have no major standards. It's your opportunity to make sure with revenue, we are accounting for it appropriately. In most of the cases I've looked at, I have agreed that they do not comply with IAS 15, and we've seen some quite big adjustments that needed to happen. Obviously, I can't count, and I've got 2 number 3s, not sure why. That should be number 4, obviously. And this is purely only for the listed space. So non-IFRS measures, if you are disclosing non-IFRS numbers, remember that there is a regulatory guide that you should be complying with that requires you to reconcile your IFRS numbers to your non-IFRS numbers, making sure we're very clearly explaining why management and why the directors think this is appropriate. So ASIC are very, very much looking at any of these non-IFRS measures. And we're seeing more and more of them. Pretty much every listing has some information within there. I said that ASIC were looking at the non-IFRS measures. One of the other things that they're very clearly looking at is the material business risk disclosure. This again is only for listeds in the OFR. So they have had so far 6 entities this year that they have required to update their material risks, expand their material risk disclosure. They do not believe that the disclosures in there are specific enough. They don't believe they're detailed enough. So making sure that we are looking at those disclosures. That media release that's at the top does name the 6 entities. If you want to have a look at what probably a good disclosure should be, probably have a look at those 6 entities next time that they have restated it, because they were absolutely on ASIC's radar. So again, it's telling me the story, telling me about the risks that you are specifically exposed to, not a boilerplate, making sure that we're covering off in detail around these. So we can see that ASIC are very much looking at some of that non-financial information. It's about that storytelling. They've really realised that people are looking much more around what else is in there. Cyber, sustainability, what else are we actually being exposed to? Which leads us beautifully onto greenwashing, which we can't have any session on external reporting without making sure that we are covering off on some sort of sustainability. This is a space that is moving incredibly quickly, and we will talk about the standards a little bit later on. So first of all, if we look at what is greenwashing, I'm sure you've all heard the terminology. There's lots of different definitions. I've got 2 definitions of that on the slide. The interesting thing about the ASIC definition is that bullet point. Greenwashing is not limited to environmental claims, but extends to misleading ethical propositions. If you are trying to make out that you are making the world a better place and you can't support it, whether that's in the green space, whether it's in the modern slavery space, whether it's in the diversity space, there are people out there very clearly watching to see what people are disclosing and can they be supportable. So we need to make sure that any claim that you are putting in any document or any website page or any social media feed is supportable. Your auditors may well ask you the question if they read anything, because they have to read the annual report to make sure that there's not inconsistent information. But at this stage, there is no audit happening of these. There is no mandatory requirement of entering credentials. It's very much around making sure that you're aware of what they're saying. So what do we have to say in respect to the standards? There is nothing in the accounting standards around climate change, but there was nothing in the accounting standards around COVID either. Yet we all dealt with that and we all disclosed because it was so significant for us that we all had an impact, or possibly we didn't have an impact, but we disclosed that we didn't have an impact because our investors were expecting to see that. So consequently, it is very much our standards are principles based. We are seeing that we have got a number of major global investors who have said they will not invest in any entity that does not talk about their green credentials. We are seeing the standards in this space move incredibly quickly. And I would encourage you all, even if you are not going to put any disclosures in, to be thinking about how could climate affect any of the reported numbers that you've got. The International Accounting Standards Board has just commenced a project on climate-related risks because they said, we do not believe that these disclosures are sufficient and we're trying to figure out why. Is it because people don't understand it, or is it because they actually need a bit more guidance in relation to that? So if we think about some areas that might have an impact in relation to climate sustainability, could be things like the useful lives of your assets. You thought you were going to hang on to something for 10 years. Actually, it's not the most environmentally piece of machinery that we've got. It churns out a lot of gunk. So quite possibly we're going to have to reduce that useful life down to 3 or 4 years, which will accelerate our depreciation, for example. It might be things like impairment. So what are we dealing with? And have we actually ended up with an impairment because where we're located, we're in a flood zone and we're finding that the asset is just not able to stand what we're being subject to. In the financial instrument space, we're seeing a number of instruments that have been offered, some loans that have been offered, but the interest rate is linked to your green credentials. The greener you are, the lower the interest rate is. So is that something that is a product that might interest us, and how can we prove our green credentials? At this stage, as I said, there is no mandatory standard that deals with reporting in Australia around climate, around sustainability. I don't think I will be stood here next year saying exactly that thing. I think we will have mandatory standards next year. So we are currently at some date in May, not sure what date, but towards the end of May. The International Sustainability Standards Board, which is different from the International Accounting Standards Board, their sister bodies, we are expecting their first 2 standards to be issued by the end of June. Standard number 1 will deal with general sustainability. Standard number 2 will deal with climate-related risks. At this point, it is the AASB in Australia who will decide the applicability of those standards in conjunction with Treasury. We have seen some Treasury discussion papers gone out. The word around the street is that it will be large listed, no definition what large listed means, and financial institutions will go first. However, I think this will very, very quickly become almost a mandated best practice, because I think we're seeing more and more questions around this that are being asked, and it is moving way quicker than anything we've seen in the past. So I guess my key message is be careful about what you're saying about how green you actually are, but making sure that you are considering how climate-related risks, how other risks might affect any of your reported numbers in the financial statements, and disclosing the inputs around that. All right, so let's look at what's happening in the reporting space. I will warn you, these are not the most cheery slides, but something we have to think about. So if we look at what is happening at the moment in the current reporting environment, nothing on here, well, except potentially the people are working from home, is positive. We are seeing some almost a perfect storm that's been created in what we've got here. We have got huge supply chain challenges. We can't get products through the door. I am looking to change my car next year. And I've started shopping for cars now because you have to go into the shops, the garages, and go, what's the wait list on the car? And so I'm still being told 16 months on some cars, which is insane because a lot of them are sat offshore on the boat, but they just can't get the cars through the door. So we're seeing huge supply chain challenges, which means that if you are in that industry of supplying products, who are your customers and are they going to wait for them? Is it something that could switch alternatives to? Do we need to switch an alternative? Do we need to start looking at manufacturing in Australia potentially? Although that has increased costs as well. I'll talk a little bit more about inflation and interest rates on the next couple of slides. Obviously, huge labour shortages. Pretty much everywhere you go, there is vacancies. LinkedIn is full of, everybody's got a little thing on hiring on the LinkedIn thing. We can't get the staff that we need. People are being accelerated from visas coming through, but we're still seeing huge labour shortages. What does that mean? Does that mean that you're struggling on your quality? Does that mean that your customer service just isn't happening the way that it should be? Wages underpayments. Again, almost everywhere you can see another entity that has been pinged for wages underpayment. Have you looked at the awards that you are paying people under? Have you made sure that you are quite accountable? Have you had a payroll audit? You don't want to be that next name in the media about underpayment of staff and huge fines that are occurring. I probably never ever thought when I started doing this that I would ever write a slide that had espionage and foreign interference on it. The reason that I've got that is because ASIO has actually listed that as the biggest risk in Australia that is a greater risk now than terrorism. I was talking to Aidan prior to the session, and emails are being hacked. We've seen security breaches at all times. One of the reasons that's deemed for that is our involvement with the UK submarines. So we have put our heads up above the trenches and said, hi, we're Australia, we're here, come get us. Because people want the IP, they've realised that we're actually capable of possibly doing more than we thought. We were just seeing this island in the middle of nowhere. So consequently, the whole cyber, the whole looking at insider trading and insider espionage is something that has really raised its head. Unfortunately, way more than we ever wanted it to. So what are you doing internally for your systems? And they could be quite costly. Insurance is going through the roof in relation to this. The improvement to systems is incredibly costly. Let's move on to inflation. So I wanted to link it back, particularly in how it might link through to financial reporting. We've talked about onerous contracts a few times already today, so I'm not going to go through that one anymore. Leases. If you have a lease calculation and it has, or your lease has a CPI, what we've always said is that you can't guess what CPI is going to be. So you have to, every time the lease calculation increases, you have to increase the value for the CPI when you know it, and you assume that that payment will be exactly the same payment over the life of the lease. With CPI increasing, this is something that we can't argue will not be material. So consequently, we're seeing significant increases in lease liabilities, right of use assets, which links through to depreciation. Useful lives I've talked around in respect of sustainability, but also in respect of if prices are going up and we expected to replace an asset after 5 years, can't actually afford to now because the price has gone up so much. So therefore, do we need to extend our useful lives? Leave provisions. If we know we have a salary increase at the 1st of July, we have to increase our provision at the 30th of June for that salary increase. Now, we are seeing salaries increasing big more than we had previously. So again, potentially that could be a big increase. We can't ignore that. Inventory. Again, we've talked a little bit about inventory. So costs are going up. Can we pass that price on to the customer? Or are we starting to see NRV provisions that will need to be bought? We don't see them that often. I suspect this year we'll start to see a lot more of those. Have you got anything else that's got an inflation-based clause in there that might mean we have to change the numbers? Interest rates. Obviously, interest rates are going up. What does that mean for our financial reporting? We may have a debt covenant that is an interest cover debt covenant. Now, it's ironic because interest keeps going up. We actually breach the interest cover debt covenant that the bank has implemented for us. But it may well happen because remember that when we talk about interest, we're talking about interest on leases, interest on bank borrowings, and potentially unwinding of provisions as well. So your interest expense will be quite significant this year. Inventory financing, if we've had to take out more debt to try and pull the inventory in because it's got more expensive, it's an extra debt that we've got. Can we meet that? Because again, interest rates keep going up and traditionally they're a little bit higher interest rates. Impairment. I've talked about we have an impairment indicator. Market interest rates are increasing. Why is that an impairment indicator? Because if you look at the value in use, it's a discounted cash flow. Even if nothing has changed, you increase the interest rates, you lower the cash flows, which means potentially we're ending up with an impairment. Provisions, as we unwind the discount on our long-term provisions, we're unwinding it at a bigger rate because of the increase in the interest rates, which means higher provisions. Leases, everything comes back to leases as well. So we don't change the incremental borrowing rate on a lease unless something in the lease has changed. But if you reduce the term of your lease, if you reduce the scope of your lease, you are going to have to change the interest rate, which means a lower lease liability, but higher interest expense again. Going concern, we've talked about that in respect of asset focus areas, so thinking about the disclosures that you've got in there. One thing we do know is that any assumptions, judgments and estimates that you made last year will not be the same as the ones you make this year, because we are not in the same economic climate, we are not in the same environment that we were in last year. So consequently, making sure that you understand which discount rates you're going to use throughout the financials, which other assumptions that you are going to make, and can you support them. If you have any share-based payments, you might find that because of the results of that you've got so far, there's no way you're going to make those hurdles. The easy option sounds like, let's just cancel it and let's just issue another share-based payment program at some point down in a few years' time. It sounds like the easy option. It is the worst thing to do, because if you cancel a share-based payment without a replacement program in place, you actually accelerate the grant date to fair value, which could mean you end up with more expenses than you weren't expecting. Last one I've talked about in respect of the asset focus areas. Just be aware of what is happening in that 30th of June.
The only question, we did get one question beforehand, and that was someone asking quite a particular question about the ASIC exemption that's available for small foreign-owned companies for requiring to be audited. So there's a requirement for all foreign-owned companies to be audited in Australia, that there is an exemption available for that, which is providing you apply to ASIC and meet certain requirements, which is including amalgamating all sister companies in Australia to see if it's still small. There's no changes to that, none that we're aware of upcoming, but we'll keep everyone informed if there are any changes. Now, before we finish up, I want to draw your attention to a very important publication called The Bottom Line. Now, what's The Bottom Line? Well, that's a publication that keeps you in the loop with all the latest accounting and financial reporting developments. Now, lucky that one of our esteemed guests, well, James Friend, who works here at HLB, he's written an article on rising interest rates, how they may impact student reporting. Carmen's given you a bit of insight of what's going to happen there. So have a look at that article as well. A few other articles in that publication. There's one on why you should expect your auditor to be asking more questions this year. That's all you want, your auditor to be asking more questions. Reason for that is a new auditing standard. It's called ASA 315. That requires the auditor to look at the environment the company's in, its internal controls, in particular its IT controls. And that's where you can see a lot more questions. There's a lot more happening in the background. There's new definition of significant risk. The auditor has to stand back. That will require a lot more documentation, but the bit that you'll probably see directly is regarding the IT environment. So it's looking at general IT controls, and it's looking at specific controls regarding the software that we use. Now, you might say, why are we doing this? Well, that's because the standards require it. It should provide a more robust audit. We'll get a better understanding of your systems, etc. But it is going to be something that's impacting on all these upcoming June audits. So beware, we'll get armed for even more questions. And there's another article on the proposed Tier 3 reporting for not-for-profits that Carmen touched on earlier. That's everything. Thank you again for joining us in person. And for those joining us remotely, thank you again. And we hope to see our next financial reporting update, which will be in November.